All right, welcome back to The Explainer. If you've been watching the markets lately, you know the financial world is seriously bracing itself right now. We're heading into the final week of April 2026, and two of the absolute most dominant forces in the global economy, Visa and Mastercard, are scheduled to release their earnings reports. To put their scale into perspective, collectively, these two titans process over 75% of non-cash transactions in the Western world. That is massive. Now, most retail investors look at them and see the ultimate safe havens. They just assume these companies are totally impervious to market shocks. But as we started really digging into the data to fill a value investing gap we've noticed recently, we realized there might be a pretty serious storm brewing just out of sight. So today, we're taking a rigorously data-driven look beneath the surface. We're going to uncover whether these market favorites are truly resilient against the macroeconomic volatility that's currently shaking up the globe. Okay, let's dive into this. It is incredibly tempting, isn't it, to look at this payment duopoly and just assume they are completely bulletproof. The common logic goes something like this. Hey, as long as people are out there buying things, Visa and Mastercard are collecting their tolls, right? Well, today, we are going to completely challenge that prevailing retail assumption. We are setting the stage for what I think is a really eye-opening look at the illusion of safety versus the brutal reality of what's actually happening with consumer credit, shifting spending habits, geopolitical shocks, and some deeply sophisticated technological overhauls happening behind the scenes. I want you to just let that number sink in for a second. $1.277 trillion. That is the massive, truly unprecedented weight of total U.S. credit card debt as of April 2026. If you want to put that into perspective, that is larger than the entire GDP of many developed nations. And it is just sitting right there on consumer plastic. It's a staggering figure. If you look at the chart, it basically looks like a hockey stick of relentless borrowing. Honestly, this number is the canary in the coal mine for our entire economy. It hints at the deep, systemic, macroeconomic vulnerabilities that are hiding right beneath the surface of our everyday consumer spending. Here is our roadmap for today's explainer. First, the safe haven illusion. Second, tracking cross-border volumes. Third, the looming default shadow. Fourth, defending margins with AI. Fifth, fintechs challenge the rails. And finally, number 6, the battle of the titans. We are going to move systematically right from the prevailing market consensus straight into actionable, deep dive equity analysis. Starting off with Section 1, the safe haven illusion. Right now, the market is pricing in this remarkably sunny consensus. They are betting heavily on a soft landing. Basically, the assumption is that inflation is going to magically cool off without triggering a massive recession. And you can see that optimism perfectly reflected in the cold, hard numbers expected for these upcoming reports. For Q1, Visa is expected to post $3.09 in earnings per share on $10.7 billion in revenue. That's an 11.5% year-over-year growth. Meanwhile, Mastercard is looking at $4.38 EPS on $8.25 billion in revenue, with growth trending even higher, somewhere in the 15 to 17% range. And this brilliantly illustrates how the market is totally pricing in an illusion of safety. Visa is currently trading at a 22.48x forward multiple, and Mastercard is sitting at a massive 25.02x premium. From a pure value investing standpoint, they're priced for absolute perfection in a macro environment that is, quite frankly, far from perfect. Which brings us to Section 2, tracking cross-border volumes. To really understand why that market perfection might be deeply flawed, we have to look at the actual engine of profitability for these networks. We need to pivot away from domestic earnings and look closely at the high-margin international segment. So what exactly is cross-border volume? Simply put, these are transactions that involve currency conversion and international settlement. Imagine you travel to Paris and you swipe your American-issued card for a coffee. That is a cross-border transaction. Now, why does this matter? Because they carry significantly higher take rates. The percentage of the transaction that the network gets to keep as a fee is much, much larger than a standard domestic swipe. Recently, Mastercard saw 14% growth here, outpacing Visa's 11%. It acts as this brilliant proxy for global economic resilience. It tells us whether affluent consumers are actually out there spending globally. But here is the major flashing warning label. This high-margin metric is incredibly sensitive to geopolitical shocks. And right now, we are in the middle of a severe geopolitical shock. The 2026 conflict in the Middle East is fundamentally disrupting global travel routes. Think about this. The Middle East handles a massive 14% of global international transit traffic. It's a vital connecting hub for the entire world. But according to UN tourism estimates, international arrivals could drop anywhere from 11% to 27%, depending entirely on how long this conflict lasts. That directly threatens this critical transit hub. It's actively cutting off a massive pipeline of those high-margin cross-border fees that Visa and Mastercard absolutely rely on to justify those sky-high multiples we just talked about. And the cascading effects of this shock? They're brutal. With Brent crude oil surging to $119 a barrel, aviation fuel surcharges are absolutely skyrocketing. That acts as a direct, unavoidable tax on travelers. Furthermore, we are actively witnessing a luxury retail crash. Sales at some Middle Eastern malls have plummeted by 70%. Plus, there is a $100 billion risk hanging over global ad spending right now. So what does this actually mean for payments? It means the velocity of money is shifting. In the simplest terms, consumers are trading their high-margin luxury international vacations for low-margin daily groceries at home. Think of it like this. If you skip a $5,000 international flight and instead you spend that same $5,000 over a few months at your local supermarket, the total dollar amount swiped on the network is exactly the same. But the profit margin for Visa and Mastercard, it gets completely compressed. Let's move to Section 3, the looming default shadow. Let's bring the focus back home to the U.S. consumer for a minute. We're moving from global travel shocks straight into a very real, very present domestic credit squeeze. I call this the default shadow. It's essentially a widening bifurcation, a split in consumer credit. Right now, sticky high interest rates and severe stress in the subprime market are being completely masked. They're hidden behind a seemingly low headline delinquency rate of just 2.94%. In the investing world, people are always chasing dollar-age stability. They want assets that generate reliable cash flow no matter how old the underlying debt gets, like a reliable dividend from a utility company. But the brutal truth of the matter is that the lower-income consumer is actively breaking right now under the weight of sticky inflation. Those neat, tidy headline numbers simply haven't caught up to reality yet. Let's connect that huge macro $1.27 trillion debt number to the granular, everyday pain that consumers are actually feeling right now. The average current APR on a credit card is 21%. And if you go out and open a brand new credit card today, you're looking at a staggering 23.75% interest rate. When rates are this high, a huge portion of a consumer's monthly payment just vanishes. It just goes to servicing the debt. If 25 cents of every single dollar you pay is just interest going to a bank, that actively and aggressively curbs your daily discretionary spending. If people are forced to stop buying non-essentials like dining out, upgrading electronics, or traveling, it directly threatens the transaction velocity that Visa and Mastercard desperately need to maintain to hit those lofty earnings estimates. That takes us to Section 4, defending margins with AI. So you might be wondering, how exactly are the payment giants responding to all this intense margin pressure? Well, they aren't just sending out letters to merchants broadly raising their flat fee percentages. No way. That would cause a massive public uproar. Instead, they are implementing this stealthy, highly technical overhaul of their interchange networks using AI. Let's actually step through the exact mechanics of Visa's new commercial enhanced data program, which is also known internally as Product 3. Think of this a bit like an express toll lane on the highway. When a merchant swipes a corporate card, Visa now runs a near real-time AI audit. It requires full line-item verification of the purchase before they will apply a lower, verified take rate. So the crucial point here is, if a merchant's back-end technology is just too slow or too outdated to instantly feed this exact granular data to Visa's AI, they essentially get kicked out of the express lane. They get bumped into the slow lane and hit with a higher processing fee. It is a brilliant, entirely stealthy way to functionally tax less sophisticated merchants in order to protect Visa's own margins against inflation. Moving on to Section 5, fintechs challenge the rails. It's not just internal margin pressure, though. Visa and Mastercard are also fighting some massive systemic threats from the outside. We are currently in the middle of a major liquidity squeeze, and agile fintech disruptors are actively exploiting it. Let's look at Robinhood's incredibly aggressive pivot. They just launched the Robinhood Platinum Card. It carries a $695 annual fee, and it is directly targeting the highly profitable, affluent customers who would traditionally hold an Amex Platinum or a Chase Sapphire Reserve. Robinhood is offering an insane 10% cashback on hotels booked through their portal. Now, you might ask, why take such a massive, aggressive loss leader? Well, Robinhood currently has $314 billion in platform assets. They are using this premium card to build an incredibly sticky ecosystem. They don't just want you to trade stocks, they want to capture the entire financial life of the affluent consumer, pulling them completely out of the legacy banking ecosystems. And honestly, it gets even deeper when we look at the very infrastructure of money itself. Traditionally, legacy settlement takes 2 whole days to clear. In the industry, this is known as T+2 settlement. This creates massive liquidity friction for businesses who just have to sit there and wait for their funds to become available. But let's move to Sophie and see how this builds with what Sophie is doing. They have actually partnered with Mastercard to bypass these legacy delays entirely. They are using their SoFi USD stablecoin integrated directly with the government's FedNow system. This enables instant 24/7 processing. They are literally upgrading the plumbing of the global banking system from the inside out. By utilizing decentralized settlement, they can completely outmaneuver traditional bank friction and provide businesses with the immediate liquidity they're desperate for right now. Finally, Section 6, the Battle of the Titans. Which brings us to the real climax of this explainer. With global shocks disrupting travel, a squeezed consumer burdened by record debt, and hungry fintechs waiting at the gates, who is actually better positioned for a potential 2026 recession? Is it Visa or is it Mastercard? This is where their strategic divergence becomes crystal clear. Notice the stark contrast in their financial DNA here. Visa boasts a true fortress balance sheet. They have $14.7 billion in cash on hand and a highly conservative 55% debt-to-equity ratio. Mastercard, on the other hand, is built as a high-growth engine. Their value-added services are growing at a blazing 22%, which is great, but that growth is heavily leveraged. They are carrying a massive 245% debt-to-equity ratio. Now, what's really interesting about this slide is the core philosophy it reveals. Mastercard is built for maximum speed in a bull market. Visa is built to weather a brutal storm. And when we look at their last 12 months operating margins, we see the direct, undeniable result of these differing strategies. Visa operates at an absolutely astonishing 68.0% margin, while Mastercard sits at an impressive but noticeably lower 59.2%. Think back to that default shadow we talked about earlier. If that shadow causes banks to suddenly tighten consumer credit, overall transaction growth is going to stall. In a higher-for-longer interest rate environment, Mastercard's heavy debt load becomes incredibly expensive to service. This makes Visa's cash-rich fortress balance sheet the far superior defensive play for value investors who are looking to protect their downside while still wanting to participate in the lucrative payment space. So, we arrive at the ultimate question for anyone watching this space. In a high-rate stalemate, are you investing in the toll booth? Or are you betting on the traffic? Visa and Mastercard unequivocally own the technology of the payment rails. There is no denying that. But their near-term success is still deeply, intimately tied to fragile, highly leveraged consumer spending. As we watch the earnings data actually unfold this week, ask yourself, is their undeniable technological dominance enough to outrun a tapped-out consumer? Thanks for joining me on this explainer today, and I highly encourage you to keep tracking these macroeconomic ties. The real story, as always, is right there in the data.